What's up, guys? It's Morgan at Lynchpin. Welcome back if you're an existing subscriber. If you're new, hope you'll stick around and find some value in the videos. Today, I'm going to talk about my strategy for the rest of 2023. I'll break down specifically the options I'm looking at. Yes, I'm looking at shorting or hedging the market. With that, as I've talked about before, 401k Roth IRA, I'm a strong believer in the market over time and dollar cost averaging, if you're not familiar with that. So without further ado, let's get into the news. All right, so first up, as the close of Friday, last Friday, markets were up decent, 1.5%, 2%. You'll notice the market overall was pretty green. And I like to use FinViz just to get a snapshot of what the market's doing that day. Again, if I'm going to make a whole market play, especially, I kind of like to take a look at that. You'll notice the major news stocks were stuff like Apple, Amazon, Tesla, etc. So that's kind of where we're at currently. Now, if you haven't been paying attention, the Fed is talking about more rate hikes. They're actually being hawkish on this. And the market kind of downplayed this. I felt a little bit. A lot of the analysts are saying, hey, we've already factored in X amount of rate hikes over the next little bit. But the truth is inflation is still going strong. And the thing is we had like one report where it was down and then now it's right back up. So my opinion on this is that the Fed is going to overcompensate and overdo it and thereby cause even a deeper recession than we're already in. I work with business owners directly face to face every single day. That's who my clientele are. And, the consensus is we're in a recession. Things are getting harder, not easier. Despite some things falling off the list of issues, there's still continuation there, and there's still a lot of bottlenecks in supply chains and things like that. Again, that's kind of my core background or my experience as of right now. Now, I'm not big on Wall Street analysts, so usually I don't dig them very much, but I will admit that Mike Wilson is probably one of the best on the street, in my opinion. Some people don't like him because he calls, recessionary situations. He's of the opinion that the market could decline as much as 26%. We'll look at that on our chart and kind of try to marry that with what's going on currently. But I will say, despite the fact that timing the market is almost impossible for anyone, I would say he's at least a voice of reason or someone to listen to, especially if he says that the market seems overvalued or has issues, because in 2020, 2021 as well, he's made some particularly accurate calls, in my opinion, just based on his approach to the market. And again, I feel like he's a voice of reason when everybody else is like, nothing to see here. It's all good. The party's still going on. Cue the music. So we'll take that with a grain of salt, but let's look at that. All right, here's the other piece. So consumer debt hits record 16.9 trillion as delinquencies also rise. With the Feds raising rates, those interest payments that you're making just increase exponentially alongside that. And this is the thing, a lot of these retailers have come out with really strong earnings or even stronger earnings than expected, beating consensus, but their projections are lower. And this is including companies like Walmart and Amazon, etc., because they're starting to see that weakness creep in. And I think a lot of it has to do with this. A lot of people have been like, well, consumer debt's way high, but you got to take that with a grain of salt. Listen, people are going to run out of money to spend. Banks are not going to be lending as much. I'm not saying this is the apocalypse. All I'm saying is cause and effect, right? And this is no different than any other time, in my opinion. And so, yes, certain factors can be different, but just pay attention to some of those types of things. That's what I'm doing. All right, so right now, the SPY is at 404, okay? When looking at this 26% decline, theoretically, that Mike Wilson's talking about, roughly where would that put us? Well, that would put us somewhere around 300 on the SPY. And if you notice from the chart, these are long-term trend lines, and you got the support and resistance levels. You'll actually notice that 300 is roughly a support level. Usually those round numbers are a good support level. And you could make an argument for putting it there. I have mine at 293. But in looking at this and the risk reward scenario, okay, Right now we're in early March. How long would it take for the market to crash? So ignore the 60 days or whatever on my chart. I'm not saying it's going down that fast. But my opinion is that if it were to, and I would say there's a good chance based on, again, just discussions with business owners, that my opinion is that's not an unreasonable level to pull back to. If you look at that, that's actually where it was pre-pandemic. And think about all the problems that have kind of taken place since then. And you've got these railroad derailments and all kinds of stuff, just still supply chain issues like crazy. You got the chip wars. I think there's a lot of economic headwinds. And I think that's indicating where the market will be, not where the market is. And so I think this is reasonable play. Let's take a look at one other factor before we look at the options change themselves. And that's going to be the historical returns by month for the S&P. Yardeni does this awesome breakdown from 1928 to 2023. So you can actually see the S&P performance by month over that time period. Now, I want you to notice that February historically has been down. So has May, and I mean barely. This is super marginal. But September has consistently been the worst month. So you hear the sell in May, go away type thing. But this kind of has a basis in what I'm talking about as far as the position that I'm going to take. Mike Wilson is saying we're basically at the precipice. He believes that the down slope begins now in March and would continue into like the middle to end of this year. April tends to be strong historically, but you can also see that there has been 34 times historically that April has been a down month and not an up month. Does that indicate anything? No, not necessarily. It's just food for thought. Another wrench to throw in the gears. I do think it's pertinent. I do think it has some association. And so here's my thought process. I like the risk reward profile of buying naked puts for the 19th of January, 2024, the $300 strike. Now, the reason for this is it's only $430 a contract, and the max return on the risk is 6,800%. I don't believe I'm going to get that. I think that risk reward profile and how little that's going to cost, I would bet that in the next 9 months, we see enough of a move that I can profit from it and get out. So that leads to the question, what would be my exit strategy here? Well, let's break that down. So exiting a play like this is going to have like 3 or 4 different decision points. All right. Number 1, market jumps or dives really quickly. Regardless of what that catalyst is, there could be a day where it drops 3 or 4% and you see 30 or 40% on that particular options play. If that happens, close it out, come back later, reposition yourself after the calm has settled, or hold if I think it's going to continue down. So that's decision point number 1. Decision point number 2, by the end of Q2, so looking more like July, where is it at? Do I think it still has a possibility to profit over the next 6 months? If that's the case, continue holding. Okay, I'll make a decision there. The other situation is based on Fed strategy. So if the FOMC meeting ends, they come out and they say, okay, we're stopping rates. Okay, even if it hasn't jumped yet, get out, run away. Again, those are the 3 strategies that I'm kind of focused on as far as exiting. Now, let's take a look at one of the other potential options. For the 15th of March, 2024, $300 puts. These would only be $545. Again, not that much more. And you would have an additional 3 months to make a determination. A lot of times people are calling for a recession years in advance of the recession actually happening. I'm as guilty as anyone of that, thinking like, there's a lot of bad news. I would have thought by now we would have hit something. And again, having discussion with actual business owners of varying types of companies, varying industries, sizes of companies, things like that, but it being pretty consistent across the board, like, hey, there's a lot going on here. I'm not feeling real comfortable, et cetera, et cetera. So it sounds like a broken record. Again, this is another option. This has a 5,400% maximum return. Again, that's not what I think I would get out of it. The nice thing about the SPY options too is you can easily buy dozens to a couple hundred contracts, and you should over time be able to liquidate that position and not necessarily get stuck in a trade and screwed over, especially if you have a significant position built up over time. All right, so from advisor perspectives, this is another thing that comes into play for me. I really like this website and the breakdown of the traditional valuation indicators. Now, a lot of people go, oh, we're in the tech age, none of that matters now. Yeah, you can argue that, but I mean, historically, it's kind of happened a couple of times already within my lifetime for those corrections to happen, and we're still way up there. I wouldn't be opposed to this idea, especially if there's additional macroeconomic issues. You got inflation, you got Fed overcompensation. There's so many things that can go wrong and a lot of things that would have to go right. So that's just kind of my opinion. And that's why I like breaking that down. All right, you may or may not have seen this before. I actually think it's pretty accurate though. Just kind of talking about stock market cycles. And this is something that we've kind of seen. Again, I don't call retail dumb money. I am retail, and I know a lot of really good traders that are individuals. I know a lot of people who, Wall Street bets everything and they've blown up a few accounts. I myself have blown up a few. So it's one of those things where, I do think this is really a repeatable cycle. And I don't disagree with the idea that we're in a return to normal situation after this initial drop. I do believe that, again, the headwinds and stuff, there is significant downside to be seen still. I think it will happen again. Maybe I'm wrong. You can come back and call me out for, fear mongering or whatever. But I personally just don't see how this carousel can continue under these conditions, even if they start printing money and all of that again. I just think we're kind of at that inflection point, and I think regardless of who tries what, they're not going to be able to stop it now. There's too much momentum. I view this as an opportunity, not a terrible thing. And, market resets and stuff like that, they happen. These things happen repeatedly. That's why they're a cycle. So anyways, when you want to say it's different this time, cool, whatever. I plan to make money up and down, which brings me to the actual play, up or down. Doesn't matter. I'm going to be continuing to contribute to my 401k, my Roth IRA. All of those investments are long-term investments. Over time, those have proven worthwhile. So that will continue from my end. I'm hedging my portfolio with 19th of January 24 320 puts. That's a typo. 300 puts as I looked at. 320 puts wouldn't be a bad idea if you don't think it's going to correct as far. Let's say you think it's going to go down. So, that's not a terrible recommendation, but again, 300. And I'm going to play the short bias with Fed policy on basically any other play. All right. So what are your thoughts? Do you think that this is a good play from my end? Do you think this is dumb? Do you think I'm going to be completely wrong, closing my position for a loss in, say, a couple of weeks to a couple of months? What are your thoughts on the overall market? But again, these are some of the factors that I'm weighing in on top of the day-to-day discussions I have with people. And again, I've actually found that I'm pretty adept at shorting. I don't know why. I really like to be bullish on things, and I own shares and tons of stuff that have done well. But like, for instance, in my Netflix trade that I posted about just a few weeks ago, I'm up 37% as of close of day Friday on that. So, I'll be making a decision there. Hey, do you want to hold this? Do I think I'm still going to see that downside into earnings? Or hey, is that enough of a chunk for right now? And then maybe play something else. But anyways, give me your thoughts. I'd love to hear what you think. Thanks so much for stopping by. I hope to see you again real soon. Bye.